We'll kick it off with the broader market. Dow and S&P 500 bouncing back after selling off yesterday, but the Nasdaq just slipped into negative territory, Mike, after we saw yields go the other way and start to rise again. So really only a partial recovery. What stands out?
Yeah, the playbook is still in place. I would say today is a little bit inconclusive. It's a push. You know, we were down 2% in the S&P yesterday, regained 1/3% of it. Doesn't really tell you much either way. There was some pretty intense action on the downside. I will say yesterday, if you looked at the volumes in the big ETFs, it was pretty thorough. I guess doesn't mean it's some kind of final conclusive flush. I still think, broadly speaking, it feels like a month-long shakeout in the context of a pivoting of the market back towards some cyclical themes, but it's tough to pick it out of the noise of the headlines and of the just kind of the seasonal static that we've been dealing with for a few weeks.
Josh, I'm reminded that last week you mentioned that you'd used the 10 days ago Monday sell-off as a buying opportunity. Did you use yesterday as a buying opportunity?
Well, all the time, depending on the strategy. Absolutely. We have to. And I think what's interesting, and just keying off what Mike said about what's happening beneath the surface here. So the S&P looks way better than the NASDAQ. 33% of S&P 500 stocks are above their 50-day. So you don't have a lot of short-term momentum helping really anywhere. But 69%, more than 2/3 of S&P stocks are still above their 200-day. So like the sell-off that you referenced today, Wilfred, the one last week, all of this stuff is happening within the context of a market in which most stocks are still going up on a time frame that's like reasonable, right? The NASDAQ's much worse. Only 36% of NASDAQ names are above their 200-day. If you're a bull, you might look at that and say, okay, this is the washout I've been waiting for since February. But these setups are not pretty. The CBOE put-call ratio spiked yesterday, but didn't spike high. Same with the VIX. 23 is not crazy. Like 23 is not a moment where you'd be like, okay, let me come rushing in to buy everything. So you can find a lot of the high-growth tech stocks continuing to puke. Most of that is related to what's going on with the 10-year Treasury and with yields. I honestly expect that to continue. ARK is breaking down below recent support. All the names in that portfolio, ARKK is now 31% below its highs. It's at the lowest level since early June. Teladoc looks tremendously terrible. Zoom looks awful. Both of those stocks are puking to new lows. And then even the high-quality names in that cohort. Let's put up a chart of Shopify, SHOP, and then let's look at Square, SQ. These are important because these were considered to be the best of the expensive TAM stocks, if you will, and those are now rolling here. So I do think it's going to be an S&P versus NASDAQ situation going forward. I think the cyclicals will continue to benefit from the story with rates and the fading of Delta. And, I don't know that you should be lining up to buy some of these charts that are looking worse and worse right now over in NASDAQ land. I just don't see an entry here.
Shout out to whoever's on charts today. Quick work there, Sam or Crystal. Melody, great work.
I can't see it. I believe it works.
Quick work. Josh, quick follow-up question on that, though. Do you fear that if the mega caps, the sort of safe part of tech, starts to take part and follow suit within the NASDAQ, that then your kind of confidence to use every significant pullback as a buying opportunity would kind of evaporate a little bit?
No. I think it's fine. You look, those stocks have an outsized impact on what's going to happen at the index level. Like the math is the math. So the question is, can you have a scenario where Apple, Amazon, Alphabet, Facebook detract from the index level performance, but then you look and you go, oh, wait, GM is back above 50? Oh, wait, JP Morgan is 169 breaking out? So, like, you can have that kind of a market where there are very constructive moves in large cap stocks, just not mega cap stocks. And maybe you'll look at the S&P and you'll say, oh, it's down 1% this week, but there will be a lot of money made outside of those big cap techs. That might be what brings balance back to the force. So I'm okay with it if that's the market that we're in. That's what seems to be happening right now. It's fine. Nobody's getting hurt.